Hi everyone, this is Mrs. V Chen. Welcome to my Form 5 Accounting Lesson 9, and today is 6th of March 2020, and then we are going to practice one DSE paper, DSE question about retirement of an existing partner. All right, so here is the question. So the question here gives us information saying we have Alice, Brian, and Clara. All right. And then they do profit and loss ratio in this way, 3 to 2 to 1. Okay, and here's the dates. Saying Alice retired from the partnership on this date. Okay, so to make it more clear, so here is the diagram and the timeline. So before we have 3 partners, Alice, Brian, Clara, and now we only have Brian and Clara because on this date, we have retirement of Alice. Okay, now this is important. So you need to remember whenever we have retirements, we always have 3 things to do here. To do Goodwill adjustments, to do revaluation on assets because the profit and loss ratio changed. And finally, who's leaving? Alice is leaving, so that we have to close Alice capital accounts. So this is the beginning about retirement. Okay, so let's look at the things we have to do in this question. So first, we need to draw up revaluation accounts, and then we need to draw up partners' capital accounts. And after that, we need to draw up the balance sheets. Now, don't worry about the name. You just change the name, the updated name in Hong Kong to Statement of Financial Position. Look at the dates. The date is right after the retirement of Alice, so that we have 2 partners left. Okay, so here I have my revaluation accounts, and then I have my capital accounts, and Brian and Clara, because this is already after retirement of Alice. Okay, so here financed by capital, we only have 2 partners left. That would be Brian and Clara. Okay, so before we look at each point step by step, so I'm going to post this capital accounts for 3 of them, Alice, Brian, Clara, in my capital account here. All right, okay, and now let's go through the point step by step here. So point number 1 is quite special, so you can highlight this, and here is 3 of charge. It's also very special. Okay, so what is about? It is in recognition of Alice's long service. Okay, a motor vehicle with a net book value was given to her free of charge. So, and who has to bear the loss? That will be equally by Brian and Clara. All right, so whenever we come to complicated things, okay, we stop and then think step by step, always using the double entry. Okay, here my double entry related to point number 1. So credit motor vehicle, 22,000. So why we credit motor vehicle? Because after that we will have less motor vehicle. We need to deduct motor vehicle by 22,000. Since this is free of charge, so the other 2 partners has to bear the loss. So we debit capital Brian, and then we debit capital, who is that? Clara. Okay, by using, of course, how do they share? They share the profit and loss equally, so that would be half and half. Okay, so that would be 11,000 and 11,000 each. So since I have to match the place nicely, okay, I moved this a little bit to the right, so that I show clearly how much we have on debit side and credit side. All right, so now I do posting. My posting is here. Debit capital Brian and Clara by 11,000. So here is my capital. So Brian and Clara, 11,000. Okay, reason, motor. What is the name? Motor vehicle. Okay, now since we have to do statement of financial position right away, so not to waste this double entry, so this motor vehicle will be in the statement of financial position. So here is my statement of financial, and then non-current assets. I have motor vehicle. Okay, and how much do we have originally? So I have motor vehicle in the question, 82,100 minus, because taken away by Clara, so 22,000. So you can see we always follow double entry to do that. So step by step, 110, okay, minus 22,000. So I have 60 and 100. Okay, so anything else? So no more. So that's all about point number 1. Okay, again we do it step by step. So point number 2, it is premises were to be revalued to 1.4 million. So let us do comparison. So how about the nets? The net figure is smaller than this. So therefore we have to increase premises to this 1.4 million. So therefore this 1.4 million will be the new value in my statement of financial position. So I can simply go to statement of financial position to put premises. Of course it is the new value here. Okay, so if I debit premises to increase it, therefore I have to credit my revaluation account because of premises. Always the change. So what is the change? The change will be the new value minus the original value, which is 850,000. In that way, I just do it step by step. Okay, minus 800. So I have 550,000. Okay, just do it step by step. All right, next, let's look at plant and equipment. So change to this much, 107,000. So look at the original one. Oh, plants and equipment, which is bigger than that. No, sorry, which is smaller than that. Also we have to increase it to 64, from 64 to 107,000. But anyway, this will be the new value. So I always put the new value in my statement of financial position here. So now I come to plants and equipment. Okay, so always the new value, so that is 107,000. Okay, so to change this to 107,000, we need to increase this. So increase, that is debit plant and debit plant and equipment, and then I credit revaluation and puts plants and equipment with the change. So how do we get the change? The new value, 107,000 minus the old value, plants and equipment, is 64,000. Okay, I use my calculator. 107,000 minus 64,000. So I have 43,000 for the change. Okay, now we come to point number 3, which is allowance for doubtful debts was to be increased by 2,600. So of course this is not a good thing, but anyway, if you check the answer, the information given to you here, okay, trade receivable, which is a net figure, so that means you don't need to separately disclose them. All right, so anyway, we have to reduce 2,600 from this. Okay. All right, so where's my double entry? You can show double entry step by step here. So to decrease trade receivable by 2,600, and in this situation we don't do that in the income statement because this is related to retirement of a partner. So we use revaluation account for adjustments. So debit revaluation account by 2,600. Okay, so here is my revaluation account. I have 2,600 because of allowance for doubtful debts, and double entry is important. So after that, here, current assets, trade receivable. Okay, to begin with, the original 23,800 minus 2,600. You can see we always follow double entry strictly. Minus 2,600. So I have 21,200. Okay, so similarly, let's look at inventory. Inventory costing this much was to be written off due to obsolescence. Remember what is meaning of obsolescence? It means being outdated. Okay, so therefore the value should go down by 2,600. So what is the double entry again? Okay. So the double entry for inventory, to decrease it, we credit inventory by how much? 2,400, and use the revaluation account for adjustments. So here I have my revaluation account on debit side, so 2,400 because of inventory. So very obvious, so this is a negative thing, right? And this is a positive side. Okay, and therefore, what about inventory in my statement of financial position? So here is my current assets. I have inventory. So to start with the original inventory, so 33,600 minus, okay, minus 2,400 means to decrease the value of inventory due to obsolescence. Obsolescence means being outdated. So 33,600 minus 2,400. So therefore, the adjustment for that will be 31,200. Okay, so next is about goodwill. So we can say that we have finished the revaluation accounts. So now can I close revaluation account here? All right, so this is my revaluation account. Okay, so which side is bigger? So obviously credit side is bigger, so 55 plus 43. So I get 593,000. So I also put 593,000 here. Okay, and then I need to insert something here. So minus 2,600 minus 2,400. So I have this 588,000. Okay, now what is this? This is credit side bigger. This is a credit balance, and credit balance is positive. This is good. So we call that this is gain on revaluation. Okay, so this is a good thing to partners. So that, and then also we use capital account for the adjustment. Now, something important. Who's going to share the gain or loss in valuation? Remember, always the old partners. So how many of them? Old partners. So we have 3 of them. Now, this is important. Always remember that. So we have Alice. Who else? Brian. Okay, let me look at the name. Brian, B-R-I-A-N. And Clara. Okay, so their old ratio, that is 3/6, 3/6, 3/6. Again, this is important. Who's going to share the gain or loss? Always the old partners, and this is very, very important. Okay, so the old ratio should be 3:2:1. So 3/6, 2/6, 1/6. If you use your calculator to share this 588 gain, so you will get this. Okay, so this is how we close revaluation account. And since this is gain, so that is a good thing to partners. So I'm going to credit 94,000 and 196,000 and 98,000, and this is what? This is revaluation. Okay. Okay, so next we come to goodwill adjustments, and goodwill was valued at 420,000, and we have this no goodwill account was to be maintained. Again, this is method 2, all right, and which is better than you open a goodwill account, because goodwill account, this generated internally is too subjective. All right, not objective enough to be shown in the statement of financial position. But anyway, we draw up the table for goodwill. So remember, this is a table. So 420, 420, and then the old ratio, we have 3 partners. And after that, Alice is leaving, so no more, and they share equally. So just use calculator divided by 6. So I have 70,000 for Clara, and times 2. I have 140,000 and 400 divided by half. Okay, so this is the calculation, and then Alice is not here. Okay, and we just need to share this by 2 of them. So 210,000. Okay, now we come to adjustments. Okay, remember who established goodwill? Always the old partners. And right after changing the profit and loss ratio, oh, look at Alice. Okay, so Alice get a loss, right? Alice get nothing. And then look at Brian. Brian should get 140, but now more. So there is a gain for Brian. So minus, okay, so gain by 70,000. And look at Clara. Clara should get 70, so there is also a gain. So minus 70 by 140,000. Okay, this is not fair. Therefore, we have to adjust the gain and loss through the partner's capital account to debit the gain. Here, Brian. So capital Brian, and Brian gains 70, and who gained? Clara. Capital Clara 140,000, and for the loss we need to compensate to Alice by credit her accounts. This, okay, so this is what we do for goodwill adjustments without opening any goodwill accounts. Let me do posting here. So I think this will be too messy. Okay, I think this will be better. Okay, so I debit Brian 70,000, 140,000. I do goodwill posting. So this is goodwill, and credit capital Alice 210,000, and this is also goodwill. Okay, and this is about goodwill adjustments. Okay, let's check what we have done so far. We have done goodwill adjustments. We have done revaluation of assets. Now we come to closing Alice capital accounts, and which is point number 5 here, saying it was agreed that 100,000 of the amount due to Alice was to be paid by check. That means we pay money to Alice, and Alice capital account must be a credit balance. However, and then while the remaining balance was to be left as a 3-year loan, that means the amount we pay is not enough to cover the credit balance in Alice account. So what do we do here? So here, this is Alice column for Alice and Alice, and then you add up these 3 figures and you get 780. So here I also put 780. Okay, so this is a credit balance to be settled, only 100 by check. So this is bank. Therefore, this is the balancing figure goes to loan. So the balancing figure that would be 780 minus 100,000. So I have 680. All right. So what happened to this? In the bank accounts, we need to minus 100,000. So here, you start with original bank figure and minus 100,000. Okay. And what about the loan? The loan is a kind of non-current liability because it lasts for 3-year loan. It is kind of 3 years. So I have non-current liability loan from Alice, and this is 680. And how do you get 680, which is the balancing figure in Alice's column? Okay, and finally, let us close Brian's column as usual. So this is a credit balance positive, and then you just close Clara's account as usual. So these two credit balance being positive, so you can put these two figure in the statement of financial position. For Brian, we have 500. Okay, I just copy and let you see. So 583,000, and Clara is 342,000, right? That's yes. Okay, all right, so let's check. So we have done all the adjustment on debit side. Okay, and then we have finished our capital account, and no more closing balance for Alice, and then we have two left. And for these two remaining current liabilities, we have no adjustment, so you just copy this current this accrued expenses and trade payables here. Okay, so current liabilities. Okay, all right, and then you close all this by using your calculator. This is a total on debit side. Now I come to the final thing, to add the total to see whether I can make it balance or not. So the total, I use my calculator, 583,000 plus 342,000 plus 21,400 plus 28,600 plus 68. Okay, which is also 1,655,000. Okay, so this is it about the example for retirements of an existing partner. Okay, so always remember, when we have retirements, we have three things to do. That is Goodwill adjustments, revaluation of assets, and closing Alice capital account. So thank you for watching my video. I'll see you next time. Bye bye.